So certainly as the years have gone by of late, we've certainly seen a marked increase in the amount of retirement accounts that folks inherit. And I guess that's sort of a reflection of the landscape over the past 40, 50 years in America, where as pensions sort of died and people weren't collecting pensions when they retired, the funding of their retirement was solely based upon what they were contributing to things like 401ks and the like. And so now we see that generation aging and passing away. And so more and more people are inheriting retirement accounts, and when you do, the rules are very different, and obviously have changed pretty dramatically. Christina, I guess that's all just kind of part of the great wealth transfer that we've talked about on the program before.
Yeah, absolutely, and we actually have a chapter in our book about that, is what happens when you inherit funds. So this is one of the prime examples of that. Inherited IRAs have been around for quite some time, but they made some rule changes in 2020 that changed the special treatments and the redemptions that have to come out of these accounts.
Yeah, and that really is. I mean, there's a bright line in the sand, so to speak, on if you inherited an account from a retirement account from someone who passed away prior to January 1, 2020, or after January 1, 2020. That line in the sand, January 1, 2020, is really important and fundamentally changes really what your thought process should be as it relates to that particular account. So that's what we're going to get into on this segment of Dollars and Cents. So welcome on into the program where we help you make sense out of all of life's decisions involving your dollars, including what happens when you inherit a retirement account. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning. With me this week is Christina Lamb, one of our certified financial fiduciaries at Nelson Financial Planning, also happens to be an IRS Enrolled Agent. Our entire team stands ready this week to help you improve your life with a successful and cost-effective financial plan. So this is really a major shift that depends on whether the person passed away prior to January 1 of 2020 or after January 1 of 2020, isn't it, Christina?
Right. So for many years, the guidelines were unclear about, do you need to take redemptions or don't you? So starting in 2020, if the person passed away in 2020 or later, you now have to redeem the account within a 10-year period of their passing. Now, prior to that, it was under what was called the life expectancy. So you could draw out the redemptions through your life expectancy.
Yeah, so the power of that, I mean, you think about, and I remember back in those days, we were often encouraging folks, maybe you don't name your kids as the beneficiaries on your retirement accounts. Maybe you name your kids your beneficiaries on your non-retirement accounts, and instead maybe name the grandkids. And if you're doing that, and someone that's 10 years of age with a 70, 80-year life expectancy, my goodness, the amount of time and compounding that could go into that, just very, very powerful. Obviously, the door slams shut on that as of January 1, 2020.
Yeah, so the two main things to keep in mind with the changes on the beneficiary IRAs is that the account must be fully liquidated at the end of the 10th year for the person that passed away. And keep in mind, those assets are fully taxable to you.
Yeah, especially if it's a retirement account. Now, these rules still apply to Roths as well.
Correct.
But particularly if it's an account that's never been taxed, you're going to be responsible for all of that income. Frankly, I describe this as the single largest increase in taxation on your retirement accounts that really doesn't get a lot of conversation in terms of, at the end of the day, that's what the implications are. Because if you're required to take a chunk of money out over 10 years versus previously you might have had 30, 40, 50 years, what do you think is going to happen to the tax bill?
Yeah, of course, it's going to go up.
It's going to be much higher.
Or people are going to spend it.
You're going to have to. Well, then that might be worse.
Issue.
Yes. But significant changes that really relate back to this, kind of notion of increasing taxes and the amount of taxes that people pay.
Yeah. And so the second rule that comes into play, and this is where it got a little shady with most people, and the guidance from the IRS was that every year you have to take what's called a required minimum distribution out of the account if the decedent was already taking that. So the guidelines in the past weren't sure, did you have to take a little bit out in between the 10 years, or could you just wait until the 10th year and let it all grow? But the final guidance is you do have to take a required minimum distribution if the decedent was taking one already, so that you'll have to take a little bit out every year.
So that's the key thing to be looking at. If you inherit a retirement account, was the person who passed, were they taking required minimum distributions, or did they have to take required minimum distributions, or did they not have to? And if they did, then you have to also take required minimum distributions. But that calculation winds up being based more on, back to where some of the confusion is, it's based on your life expectancy in terms of that required distribution.
That is correct. Yep, absolutely.
So you got like two different tables going on here. The decedent probably had to take out a required minimum distribution. If they had to take a required minimum distribution, they were doing that based upon their life expectancy. Mm-hmm. You, as the inheritor of the account, wind up taking it out based on your life expectancy, but you got to do it.
Yes. So basically, the IRS did this in efforts to raise more tax revenue, as you previously pointed out, and also, keeping the wealthy from shielding their assets, as you were describing, basically naming grandchildren as beneficiaries on accounts. So over all of these IRA accounts.
So at the end of the day, so just to really have folks understand what the issue is here, unfortunately, the IRS took 4 years, effectively, to come up with the rule of what you needed to do. And so a lot of people were on the impression of, okay, maybe we don't need to do anything. And finally, they issued out the final rules on this. But they effectively sort of exempt, right? Whatever happened over the past 4 years, forget about it.
Yeah, so they are not penalizing anybody that has not taken a distribution from 21 to 24, where they would have had to take funds out of the accounts. However, going forward, starting with 25, you must take that distribution out, and if you don't, there is a 25% penalty.
Plus the taxes that you would owe on it as well.
Exactly.
Yeah, so
and 25% is pretty steep, and it was 50 prior to 2023.
Certainly pretty steep. And again, these rules apply to Roths as well. We're focusing more on the pre-tax side, because there you've got the tax liability, and it really does require you to kind of really think this through a little bit more than maybe what you might have in the past, because the need to be thinking about who's going to wind up paying the taxes on these accounts, that could certainly generate a much higher tax bill if you're not thinking through on that perspective.
No, absolutely. So as a retiree, you may want to consider taking more money out of your IRA account now versus letting it grow for a beneficiary. And then from a beneficiary standpoint, you want to come up with a distribution strategy. That's going to be a little bit different for everyone, considering on your tax circumstances and your income circumstances. If you inherit something like a $100,000 IRA, grows at 8% for the 10 years, you don't touch it, it's going to be $22,000 at the 10th year, when you now have to take it all, and you're going to be paying much higher taxes on that.
Yeah, double. 100,000 turns into over $200,000, $222,000. So that becomes but now the problem is the people that have missed the 4 years.
Right. So they now still have to redeem it in their 10-year period, so they only have 6 years left.
Yeah, so we're going to stay on that one a little bit longer, because that if you've inherited one of these accounts and you think, you know what, I haven't had to take anything out, you might very well have to take something out starting next year, again, depending upon whether the person that you inherited from had to take out required minimum distributions. So we're going to stay on this topic a little bit longer when we get back from the break. So stay tuned here on Dollars and Cents with Joel Garris and Christina Lamb of Nelson Financial Planning.